You deposit $1,000 into your bank account. The bank now lends $900 of that to someone else. That person deposits it into another bank, which lends $810 to someone else, and on and on. Suddenly, from your single $1,000 deposit, there's now $2,710 in circulation. No government printed new bills, no mint stamped new coins, yet somehow the money supply just tripled. Welcome to the historical Financier, where the stories behind money reveal the forces that shaped your world.
Most people think money is created by governments. They picture massive printing presses churning out crisp bills or mints stamping coins under heavy security. And that does happen, but it only accounts for a tiny fraction of the money in existence. In the United States, physical cash makes up less than 10% of the total money supply. The rest? It's digital, numbers on a screen, entries in a ledger. And most of it isn't created by central banks or treasuries. It's created by commercial banks, every time they approve a loan.
To understand how we got here, we need to go back centuries, long before digital banking, before ATMs, before paper money itself. In medieval Italy, goldsmiths offered a simple service. They stored your gold in their vaults and gave you a receipt. That receipt was essentially an IOU, proof that you had gold waiting for you. But goldsmiths noticed something interesting. Not everyone came to withdraw their gold at the same time. Most of the gold just sat there, unused. So they started making loans, lending out other people's gold while it wasn't being claimed. They would issue new receipts to borrowers who could spend them as if they were holding real gold. Suddenly, there were more receipts in circulation than actual gold in the vault. This was the birth of fractional reserve banking, the system that still runs the world today. The goldsmiths kept only a fraction of deposits on hand and lent out the rest. As long as everyone didn't demand their gold back at once, the system worked. But when trust collapsed, when too many people showed up at the same time, the goldsmith went bust. We call that a bank run. And despite centuries of evolution, the logic hasn't changed.
Fast forward to today. You walk into a bank and deposit 10,000 rupees. The bank doesn't lock all 10,000 rupees in a vault. Instead, it sets aside a small fraction, let's say 10%, as reserves and lends out the rest. So the bank keeps 1,000 rupees and lends 9,000 rupees to someone else. That borrower uses the 9,000 rupees to pay for something, maybe a car, a wedding, a business expense. The person who receives that 9,000 rupees then deposits it into their bank. Now that bank keeps 10%, 900 rupees, and lends out 8,100 rupees. That 8,100 rupees gets spent, redeposited, and lent out again, and again, and again. This cycle is called deposit multiplication or credit creation. From your original 10,000 rupee deposit, the banking system can create up to 100,000 rupees in total money supply, 10 times the original amount. No new bills were printed, no central bank intervened. The money was created through lending. Economists call this the money multiplier. And it's not a side effect of banking, it's the entire point. Banks don't just store money, they manufacture it.
Here's where it gets uncomfortable. When a bank approves your loan, it doesn't check if it has enough deposits sitting in a vault. It simply types the number into your account. That's it. Your loan isn't funded by someone else's savings. It's created the moment the bank says yes. In 2014, a landmark study confirmed what many had suspected. Banks individually create money out of nothing. The researchers called it fairy dust, money conjured from thin air the instant credit is extended. But there's a catch. Banks can't create money recklessly. If they lend too much and borrowers don't repay, the bank becomes insolvent. And if depositors lose confidence and start withdrawing funds faster than the bank can cover, it collapses. That's why central banks exist, not to create most of the money, but to regulate how much private banks can create. They do this by setting reserve requirements, controlling interest rates, and acting as the lender of last resort when banks run out of liquid reserves. In other words, money creation is a controlled explosion. It expands the economy when managed carefully, but when it spirals out of control, it triggers inflation, bubbles, and crashes.
So why does this matter? Because almost every dollar, euro, rupee, or yen in your bank account is someone else's debt. When you take a mortgage, you're not borrowing someone's savings, you're borrowing new money that the bank just created. When a government sells bonds to fund spending, banks buy those bonds by creating new deposits. The entire system runs on a single assumption, that people will keep borrowing, spending, and trusting that the numbers on the screen represent real value. But that trust is fragile. In 2008, when banks stopped trusting each other, the global financial system nearly froze. Governments had to step in with trillions in bailouts, not because banks ran out of physical cash, but because the belief in the system wavered. And here's the kicker. This system rewards those who understand it. If you know how money is created, you borrow when it's cheap, invest in assets that rise with inflation, and position yourself on the side of the ledger that receives interest payments, not the side that pays them. If you don't, you work for money that's constantly being multiplied by others, diluting your purchasing power with every new loan the system approves. Money creation isn't a conspiracy, it's a machine. And the question isn't whether it exists, it's whether you understand how it works.
So the next time someone says the government is printing too much money, remember this. Most money isn't printed at all. It's typed by banks every time someone signs a loan agreement. The system has been running this way for centuries, from Italian goldsmiths to Wall Street megabanks. It's not broken, it's designed this way. And once you see it, you can never unsee it. If this changed how you think about money, hit subscribe to the Historical Financier. History has the answers. I'll show you where to look.